Now, in the second video regarding Rivera Theatre Inc., we are now going to post the journal entries to the general ledger. Now, the ledger we're going to demonstrate as T accounts. So you see, on one part of the ledger, on the left-hand side of this equal sign, what we have are the asset accounts: cash, accounts receivable, prepaid rent, equipment, land, building, and also expense accounts, such as utilities expense, salary wages expense, and advertising expense. On the right-hand side, we have these on the left because they increase on the left. On the right-hand side, we have the liabilities, shareholders' equity, and revenue accounts. Now, we have two revenue accounts: service revenue and sales revenue for Rivera Theatre. Now, as the problem said, we had opening balances. So you can see that I've already recorded a debit in cash of $6,300, a debit in equipment of $6,000, a debit in land $10,000, a debit in building. And we also have liabilities. We have an accounts payable $2,300, and we have common stock of $20,000. So now we're going to begin to take the entries as we recorded them in the journal and post them to the ledger. To begin with, the first journal entry said a debit to rent expense of $800 and a credit to cash of $800. So to record that, then what we do is we move down to the revenue account and we put in here, and this we would just say the 2nd of April, a debit of $800. And then we go up to the cash account and we put in here on the 2nd a credit of $800. And that's how we record that first journal entry, or that's how we post that first journal entry. The second journal entry then, debit cash $4,700, credit service revenue $4,700. So a debit to cash $4,700 and a credit to service revenue $4,700. Now, mortgage payable $2,000, a debit, accounts payable $1,200, a debit, and cash $3,200, a credit. Okay, a debit to accounts payable, and this is on the 10th, so we will say on the 10th, a debit to accounts payable of $1,200, a debit to mortgage payment payable on $10,000 on the 10th, and that was for $2,000, and a credit on the 10th to cash for $3,200. And that's how we record that journal entry. Then, April 12th, a debit to advertising expense $410 and a credit to cash $410. A debit to advertising expense on the 12th $410 and a credit to cash on the 12th of $410. So we posted that journal entry. We go on to the next. The next is a debit to rent expense on April 20th of $750 and a credit to accounts payable. So in the T account for rent expense, we debit $750, and on the liability side, we have an increase in accounts payable, so it is a credit of $750, and that's how we posted to that T account for accounts payable. The next journal entry is, let's see, cash and service revenue, $3,000. Okay. So on the 25th, I recorded debit over here and cash on the 25th of $3,000, and over here a credit to service revenue of $3,000. Then on April 29th, we have salaries expense $1,900 and a credit to cash of $1,900. And so therefore on the 29th, a debit to salary expense and wages expense of $1,900 And I paid cash on the 29th. I'll bracket that, 1900. Then on April 30th, 3 accounts are affected. Cash is debited 170, accounts receivable is debited 170, and sales revenue is credited 340. On the 30th, I debit cash 170. On the 30th, I debit accounts receivable 170. And on the 30th, I debit over here sales revenue of 340. And the last journal entry is a debit to prepaid rent and a credit to cash. And so the trial balance for Rivera Theatre, Inc., April 30th, we have, and we just list the accounts in any order, cash, and it has a debit balance of $6,660. So we can put up here debit, and over here credit. Accounts receivable, I'll just do the short form here to save time, 170. Prepaid rent, and so on. So prepaid rent, land, building, and equipment. Now we have accounts payable, and we just put the account name in, accounts payable. Aha, but watch it, this has a credit balance of $1,850. And the rest with credit balances are, I record then the mortgage payable is $6,000, common stock $20,000, service revenue $7,700, sales revenue $3,040, and then we have advertising expense. And keep in mind, expenses have debit balances, so it's $410. Rent expense of $1,550, and salaries expense. So there we have all the accounts in our ledger, their debit balances and their credit balances, and we simply add them up. And if we did everything correctly, journalized and post correctly, then this should balance. And we have, therefore, in the debit side, $35,890, and on the credit side, $35,890. Same balance. And that's what we do. We have a trial balance. So we journalize in the general journal, we post to the general ledger, then we summarize the totals in all the general ledgers by listing them in any order in what's called the trial balance. Now, this is not a formal financial statement. This is simply a test, a record that tests whether your ledger is in balance. And in this case, we have debits, $35,890, and credits of the same. And there's your trial balance. So that journalizing, posting, and testing the ledger to make sure it's in balance. And that concludes this concept video.